They say, and I quote, the economy grew at an annual 2.6% pace in the third quarter, rebounding from 2 consecutive declines in the first half of the year that ignited debate about whether the U.S. has sunk into a recession. The official resumption of growth was driven largely by a shrinking trade deficit and masked emerging weak spots in the economy. Most economists also warn the good news might not last. They predict a recession is due by next year. So hey everyone, this is your host, Rob Kientz at goldsilverpros.com. This is the weekly market wrap up, and I'm recording this on October 28, 2022. You guys will see it in a day or two when it comes out on our channel, Gold Silver Pros, as well as at JM Bullion. I wanted to talk about what is going on in the economy this week. Of course, we watch all the economic data, and there are several key data points that really matter this week, and we're going to go over them. The first is to go over the U.S. manufacturing PMI and the U.S. services PMI to see how healthy our economy is doing. As you guys all know, we are mostly a service-based economy, although we do have some manufacturing, so we tend to watch both, and those data points came out on Monday. Both are in contraction under a print of 50, which means they're not growing. Manufacturing is at 49.9, really about an even number. You could say it's stagnant, not really growing or not growing, but it's technically on the shrinking side by 0.1. U.S. services PMI, the bigger part of the economy, has fallen solidly below 50. It's at a 46.6 print, which means the service economy is contracting. Both are less than what economists had expected. They had expected a 51.8 print in the positive territory for manufacturing. We got under that by about 2 points. And they in fact expected a 49.7 print on services, and we're below that on 3 points. So definitely the economists tend to be lagging what's actually going on in the economy, and their predictions right now are not all that accurate. We are decelerating faster than they believe. Looking at the Case-Shiller U.S. Home Price Index, we covered that quite a bit on our channel last week, indicating that we're having a real estate turnover heading into a crash. Well, that number came in at negative 9.8% from Case-Shiller, the most respected nationwide survey of home prices, and that is much below the number last month, which was negative 5.3%. So U.S. Home Price Index continues to fall faster and faster each month that it's measured, and that is a sign of a crash coming in the housing market. The FHFA U.S. Home Price Index had a negative 7.6% print. That was slightly worse than the negative 7.3 of last month. And a result of all these numbers, the Consumer Confidence Index has fallen to 102.5 from 107.8. That is a sentiment indicator about how consumers feel about the economy. And it was worse than the economists expected this month of 106.3. The trade in goods or the current account balance for the United States is negative 92.2 billion. That means that we are buying 92.2 billion more than we have sold for last month, which is not a great number. And that number is falling faster. And the reason for that is because the dollar is strong, and therefore it allows us to buy more goods. And therefore we are going to be more of a purchasing nation than a selling nation, which is not good for the economy long term, because it means the manufacturing that we have, because of the strong dollar, we're going to continue to buy from overseas, and manufacturing is not going to come back, while it's cheaper to buy goods from overseas than it is to make them here. And that's one of the issues with having a quote-unquote strong dollar. Real gross domestic product actually came in positive for the first time in over 2 quarters. We had negative GDP prints for 2 straight quarters. Now we've had a positive one. It came in at 2.6%. Likely economists will then say that we are out of the recession, officially don't have one. That could be true, except for the underlying economic numbers are not great. And I would argue that gross domestic product is up largely because of the dollar. And when you decrement gross domestic product for the 8% inflation that we're having right now, we're actually negative in terms of overall economic output. But because the government doesn't look at it like that, they only look at the simplistic domestic product number without discounting inflation or looking at the strong dollar in the currency, we're going to get, the economy is recovering. In fact, I think Biden was quoted as laughing, saying, see, we have a strong economic recovery, which we don't. We're negative about 5.5% when you mix in CPI, but at least there is a positive economic print, and you're going to see that all across mainstream media. Initial jobless claims are up, although they're less than economists expected. Last month, initial jobless claims are 214,000. This month, they are 217,000 on expectations of 220. So we did better than what economists expected, but still worse than the previous month, which means more jobless claims are coming in, which means the labor is actually not recovering. Unemployment is not recovering as fast as the mainstream media will tell you. Continuing jobless claims, the ones that have put in for multiple months, multiple periods, is higher at 1.44 million. Last month, it was 1.38 million. Again, another data point suggesting we do not have a true economic recovery. Core capital equipment orders, these are capital equipment for big businesses to make things in the economy, are of course down 0.7%. That doesn't surprise because the U.S. manufacturing PMI is also decelerating. It's under 50. So our core capital equipment orders that we use to produce things is also down. That makes sense. Employment cost index is up 5.1%. It means that the cost to have employees is up, although it is decelerating just a little bit. Last month it was 5.4%. And that is it for the economic numbers this week. Taking a preview for next week, we're going to get the Chicago Purchasing Manager Index to see how the purchasing managers in the economy feel about it. That'll be an indication of what's coming down the line for the retail sector. We'll look at U.S. manufacturing PMI, ISM Manufacturing Index, job openings, construction spending, motor vehicle sales, and then the big numbers are going to be employment. So it's the first week of the month. So we'll get both the ADP employment report next Wednesday, November 2nd, and on Friday, the big one, the non-farm payrolls, and that'll tell us how employment is going, although it's going to be a skewed number, and I'll add in their labor force participation rate, which comes out also on Friday, and that typically indicates the real employment levels in the economy. Talking more about the economy growing, the GDP print, there's an article here at Market Watch that I'll be quoting from. They say, and I quote, the economy grew at an annual 2.6% pace in the third quarter, rebounding from 2 consecutive declines in the first half of the year that ignited debate about whether the U.S. is sunk into a recession. The official resumption of growth was driven largely by a shrinking trade deficit and masked emerging weak spots in the economy. Most economists also warn the good news might not last. They predict a recession is due by next year. So the experts are saying the same thing I said. With a stronger dollar, that masks, are we really in a increasing economy, or is it just the strong dollar and the current account balance, which allows us to produce more in dollar terms? And if I add on to that, if you subtract out inflation, we're actually not growing as an economy because we have a much higher inflation print than we do a GDP print. The chief going back to the article, the chief source of the rebound in gross domestic product, the scorecard of sorts for the economy, was a shrinking trade deficit, as they point out, something I also pointed out. The main engine of the economy, consumer spending, has remained relatively stable this year. Household outlays grew in the third quarter by 1.4% rate. Again, if you add in inflation, that's just the more powerful dollar in the inflation, not an more actual goods being spent by the consumer. And so I'm always going to decrement these numbers by inflation to show you we're actually not growing. So you have to look beyond just the headline number. Headline here at CNBC for today, and this is as of 12:54 p.m. Central Time on Friday, October 28th. The Dow rallies 700 points on Friday, heads for fourth straight winning week. I'm quoting from the article. Stocks rose on Friday despite a tumble in Amazon shares after economic data pointed to slowing inflation and a steady consumer. The Dow Jones Industrial Average added 771 points, or 2.4%. The S&P 500 gained 2%, and the NASDAQ fought higher and was up by 2.5%. I wanted to point out that, however, we're having continued pressure on earnings reports. I'm going to give you the picture of earnings reports for the corporate sector over the last several years, but I wanted to point out that Amazon is having issues. Amazon plunged by 10% after the company posted weaker than expected quarterly revenue and issued disappointing fourth quarter sales guidance Thursday. Apple shares were initially lower to an extended trading Thursday. I also noted earlier in this week in another broadcast that Amazon Web Services and cloud is the only thing basically keeping it afloat. So the cloud has done well, although the cloud for Microsoft is not doing as well. So not all cloud products are doing well. So we don't know whether in the future Amazon Cloud is expected to continue to grow and save the company, essentially. Apple and other positive performers like Intel have given investors footholds within what some see as a particularly tumultuous tech sector, subsequently providing upward pressure. The tech-heavy NASDAQ is reporting CNBC, although I will point out that most of the companies trading in the NASDAQ aren't doing well. It's upheld by a few at the top, and some of those are starting to come under pressure. We're going to go to the screen share, and I'm going to point out a nice little chart that I had in a Jam Bullion article I wrote and printed on October 26th earlier this week. Recession or no recession, that is the question. Those of you not aware, I'm now writing for Jam Bullion and also doing videos on their YouTube channel, providing content for them. And in this article, I want to point out corporate earnings per share. This data is from FactSet. As you can see here, dating back to quarter 3 of 2018, that would be a solid 4 years of data. We've had a lot more negative prints on the economy, then we had positive ones here in green, and the negative ones. Now, the positive ones were the temporary recovery from the pandemic shutdowns, but I'll highlight and point out that we were negative growth way before the shutdowns ever happened. So it wasn't the shutdowns that were causing companies to lose money. They had been bleeding money for a solid 2 years overall in the economy when aggregated before COVID. And it was actually the restart of COVID that gave us our positive GDP prints. And why would they give us positive GDP prints? Because the economy had been shrinking for 2 years. We had this big collapse in COVID, and then we had a minor restart, positive earnings reports, but since then they've fallen back down. So in other words, the COVID restart gave us a temporary boost, but we never recovered everything that we had lost 2 years prior. And that temporary boost only lasted for a while because the overall economy was not recovering. And so therefore we've headed back in negative territory. This would seem to counteract the reports that COVID caused the economy to crash and it was rosy before, and that now that we have a nice recovery from COVID, we're back in green territory. We haven't recovered to where we were dating back to Q3 of 2018, even with the benefits of the restart. So corporate earnings are not up and overall have not been for 4 years. Therefore, there's no reason to expect that the economy is recovering or that the current stock market valuations, the price to earnings ratio we have in the market, make any sense. Because overall, when the corporate sector is faltering, why would the stock markets begin or continue to rise and continue to show value if we're not earning money? Price to earnings ratios, high elevated price to earnings ratios only make sense in a rising corporate earnings environment. That's not what we've had for the last 4 years. And this data basically proves it. Moving over to the gold trade, we're going to do our gold review as we always do. I would say a moderate amount of trading going on in terms of volume and open interest. In terms of the December contract, which is the dominant contract for the end of the year for both silver and gold, we can see that we had open interest in gold of 360,703 contracts. As you can see here, we had EFP, or the exchange for fiscal, between the US and UK markets of 5,868. That is a very large number when averaged, and it means either people are going to London trading their futures position for gold, or they're playing arbitrage between the US and COMEX prices, either one. I suspect a lot of this is gold deliveries are not getting on the COMEX. They're having to move over to London because both of those markets support each other with that EFP mechanism. Looking at the price settlement data, this is as of Friday, October 28th, as you can see up here. That's data so far. It's not final data, but you can see overall that we're unchanged, about sideways in the gold market on estimated volume of 108,000 contracts. That's early data for today. That's not finalized. So let's look back at the last closing day that we have for the December contract. You can see here that we had estimated volume of 191,000 contracts of 100-ounce gold, settled at an average price of $1665.60. That's down $3.60. If we look at Wednesday, we had a settlement of $1664.40, up $11 on estimated volume of 188,052. If we look at earlier in the week to Tuesday, the gold contracts on the December, 183,326, healthy volume there, closing an average of 1658.0, up $3.90. We'll get to the COT report in a moment, which will show you why these numbers did what they did. Over to the silver futures, now talking silver again, relatively average volume being traded. No big spike here dating back to the 21st. So in about a week, we've had what I consider a normal silver market. Not too much over interest, not too much less interest, just a nice healthy market. Again, trading on the December 2022 contract, as you can see here. I'm going to make this a wee bit bigger for you guys so you can see it. EFP 825 silver contracts. People were trying to get physical silver from London, trading off of the COMEX or just arbitraging the price in a cash position. And open interest is 107,732 as we look at it. Deliveries only 233. The thing I want to point out in both gold and silver, I'm going to go back to gold, is yes, we do have some deliveries, but it's only a fraction of what the open interest is. You can see here only 3 gold deliveries on the October contract, none on the December contract on volume of 360,000. So again, the COMEX is not a big delivery market. Deliveries do come off of it, and it's why they're draining metal, but it's not as big of a delivery market as the Shanghai, which we pointed out on the last broadcast. And yes, I'm going to start covering the Shanghai each and every video. I do this so that we can look at what's going on in China, as I think that market becomes more relevant. Now, we'll cover it on a monthly basis in terms of volume and deliveries, because that's the way they publish the data, not on a daily basis like COMEX, but on a daily basis or on a weekly basis when we do this video, we will cover the price differences, which I think you guys will find to be very interesting. Okay, back to silver on COMEX. Again, December is the dominant contract for trading and delivery on the COMEX for silver. Estimated volume so far today, this is Friday's data, not closing data, just so far about halfway through the day, 27,237 contracts, and silver is trading down 34 cents at an average price of 19.14. That's why you see the price as it is, the spot price. This determines the spot price. This settlement price here, this column right here, basically turns into the spot price you pay at your dealer. That's how that's determined, for those that didn't know. Going back to Thursday's data, the last full day of data that we have, 59,773 contract volume, settled at 19,494. That was up 8 cents. Yesterday was an up day for silver. Moving to Wednesday, 2 days ago, again on the December contract, estimated volume 56,364, settling at 19.48, up 13 cents. So this week, not too bad for silver overall. Moving on to commitment of traders, this is in arrears. The COT report from the CFTC is in arrears, so we have as of October 18, 2022, but these numbers will tell you what these numbers are, because these are the current trade or current aggregated trade data. These are the individual positions of who's doing it that leads up to what has happened in the market that week, if that makes any sense. So now we're looking at the individual groups of traders and what they're doing, which led to the prices that we see here that make up the spot that you pay at your dealer. Looking at silver, commodity exchange, disaggregated commitment of traders, October 18th, 2022. The producer merchant class usually is typically short because they're shorting downward prices of movement, especially the producers, 28,136. They dropped 2,600 short contracts, netted 2,900 long. A lot of that probably is going to go to either extinguishing some shorts of the producers or going to the merchants who expect higher prices going forward, and they're hedging against their exposure to higher silver prices because they need to manufacture. So that's a cost pressure on their business. Moving over to swap dealers or the sharps or the smart money or the bullion banks, as I call them, you can see that they dropped 1,123 short contracts in silver and dropped 248 long for a net increase of about 900 contracts to the long side. They're still net long at 43,179, net short 3876 for a net position of about 12,300 or so it looks. Managed money, which are like the hedge funds and the financial houses, are still short silver, 44,077. They're not the smart money typically in this particular market. They may be in others, but precious metals usually get their money taken from them by the swap dealers and other players. They're net short. They're probably on the opposite side of the trade. Don't expect them to do well going forward, but it's worthy to note their position because it's a very big trading group. And the managed money basically represents the billions and trillions of dollars in the stock market and the passive market. So this is a big market of money. They can come in here with a lot of contracts and lose a lot of money before it ever hits their bottom line. That's why they tend not to be the sharps, because it's easier for them to lose money, but their overall portfolios stay okay because they're not that much into this market. And that's how the swap dealers can get away with making money, taking the opposite position of the managed money. Okay, other reportables are wealthy individuals, family offices. They're net long about 9,000 contracts on silver. Makes sense to me. They expect the price to rise. Moving on to gold. Again, futures through October 18, 2022. This is about 10-day-old data, but it tells us where the prices went last week on the COMEX. And we see that the producer merchants are net short, although they dropped 4,330 short contracts in gold and went long 2,773. The producer merchants both expect gold price to go up, and they went almost 7,000 contracts, now over 7,000 contracts net to the long side. If you look at these two numbers, add those two numbers up, they dropped the 4,330 shorts and added 2,770 longs. At 7,000 net shift to the long side producer merchants. Swap dealers also going net long. They dropped 7,000 gold contracts. They're deleveraging out of their short gold position. Again, this is the bullion banks or the sharps or the smart money. And they dropped only 557 longs, probably rotating out of certain contracts. Net, they have gone net long about 6,500 contracts here. And as you can see, even though they're not quite double short position as long net, they have been leveraging out of their shorts the last few months. I think longer term, they expect gold to go up, and so do I. And I'll give you my opinion on that in a minute. The managed money is net short in gold, although they did add 15,000 short contracts, or 15,000 contracts to the short side, taking everything that both the swap dealers and the producer merchants wanted to give them. They're now more exposed to downward price movement in gold by 10,000 contracts this week. And I think that they're going to be the duped money, and they're going to lose money. They're net short about 26,000 contracts. The family offices and other smart individuals and wealthy individuals are net long gold to the tune of about 100,000 contracts net, which is a ton. So the smart individual money and family offices are betting big on forward prices in gold going higher. Going to the ETFs, typically the ETFs give us a good picture of what's going on in the London market because most of the ETF gold and silver is stored in London. Not all of it. Some of it's in the US and other places, but it gives us a good read. And if you look at COMEX, the numbers are here. I'm really going to go over the ETFs. We're looking here, and net the ETFs have lost gold. When you add in what's on the COMEX, there's been a net loss of 4 weeks, rolling 4 weeks of almost 3 million ounces. And if we look at the GLD, which is the largest of the ETFs, you can see that there's been a decrease in the amount of ETF ounces held. So gold is starting to bleed out of the London market through the ETFs and some through the American market as well. If you look at COMEX and some of the ones that store their gold on the American depositories as well. Moving on to silver ETFs, we look at net over the last 4 weeks down 15 million ounces. Most of that's through COMEX. There's been some bleeding of silver through ETF securities, PHAG, SIVR. The SLV has actually been adding silver the last 3 weeks I've been doing this. This time they add 3.4 million ounces. Now their net still down, but there's been a reversal of ounces coming into SLV. In the London market, you can see that little reversal here. Now it's this little reversal here, this little tiny little reversal you see here is a drop in the bucket compared to what's come off dating back to silver squeeze, January, February of 2021. So a little bit of silver is coming in, but not much. And that goes to show you that that market on silver in London is not that liquid because it's mostly coming off and not much coming on. That is not a super liquid market right now. I wanted to move on to price and compare the US markets with the Chinese market. Last video I did last week, I looked at the amount of physical deliveries in the Chinese market and what's going on there for both gold and silver. They only produce that once a month, so it'll be next month when I do that review again. But in the intervening weeks, we can look at price, and it's important to look at price. If you look dating back to the beginning of the year, gold is net down about this much on the COMEX, and silver is net down about this much. But if you look at gold on the Chinese market, you get different. If we look at the gold benchmark, gold is actually up on the Chinese exchange dating back to the year. So it's gone from 367.86 to now 394, and that's with the fall off during the March timeframe that the American market's also expected in the gold price. So everything began selling off across the world here, but the Shanghai has recovered quite nicely and is up net year to date. If you look at the American market, it is down net. Okay, who's buying more gold and who's selling more? The US market is selling more. The Chinese are buying more. The gold is flowing west to east. Again, the physical gold is flowing west to east. Add up the data points and we'll add 2 and 2 together. Most of the gold is coming off of the COMEX. You can see that in the charts here and here, and it's moving and it's coming off of both London and the US. This is US market. This is London with some US in. It's coming off, but as you see that the price rising in China, and it's a heavy delivery market, meaning it's coming east, they're settling the physical coming off of COMEX in London into China. China's taking that metal. Either it's the sovereign nation taking it, or it's interest in China, industrial and other interests in China taking the gold. That's why the gold price is higher, because the gold is moving west to east physically, and it's being reflected in the markets. That is a huge data point to take into account about who's going to have the gold and who values the gold. Obviously, China does. Looking at the silver benchmark chart, silver is net down in China, although not down as much as the American market. Going back to the American market on gold price, sorry. Here's silver, it's down quite a bit from about 24, about 23 something to start the year, down to 1921. So it's down about probably $4 on the year. It's not down nearly as much in the Shanghai. It's down a little bit from 4,700 on that contract to 45.84, a lesser percentage drop. I'm not going to convert that to American dollars. I'm just looking at percentages because it's all that matters. It doesn't matter dollar count. It just matters that the gold and silver is much more delivered in Shanghai than it is in London or COMEX. The price is staying higher because it's a delivery market. That means they're taking the West gold and silver and absorbing it into China. Now, the Shanghai is just a port of entry into the Chinese market. It doesn't mean it could be somebody else taking it out of China, using it for something. Maybe it's a Korean manufacturer making TVs. Maybe it's Apple. Maybe it's the sovereigns of China saying we need gold and silver and we're going to take it off the Western market because the government needs it. We don't know. We just know it's flowing west east, and that's what the data tells us. I also want to point out for the last 2 days, October 27th and October 28th, the settlement price in China is higher. So the one conversion they do between yuan to dollars is on this chart. And I'm just going to go over the last couple of days for you. And I've noticed that the difference in price between the two markets is about 43 bucks. So if you look at COMEX gold futures, 1664, if you look at the price, the equivalent American price on for about the same contract on the Shanghai exchange at 1707 for an increase of 43 bucks. So for $43 increase for gold between China and the US, that means that China is paying $43 more per ounce of gold. That's why the physical is moving. China has figured out, and not only China that runs the Shanghai, but also all the players that play through the Shanghai, companies, banks, all that, individual traders, know that China and that part of the world values gold more. And so what they're doing is they're using arbitrage between the London and the COMEX markets here in the US, and they're getting a higher price in China, which is a higher physically settled market, which means the gold is flowing west to east. And for yesterday's data, it's actually up a little bit, or today's data is actually up a little bit more. It's $43.20, the difference. And so you can see right there that the Chinese are basically taking the gold from the West. That's how you figure that out. And that's why we cover that market here. The big news is corporate earnings are not quite what we expected, that they were going to be. And that's led to a more positive environment for gold and silver, I think, going forward, because the gold is just being bled west to east. And I think if you look at the economy and what's going on corporate earnings with the consumer, we're definitely in a recession. And I don't know how soon we're going to come out of that. But regardless of dollar and CPI, it tends to downplay the positive GDP numbers that we have. This is going to do it for the weekly market wrap up. Stay tuned for the metals update if you're watching this on Gold Silver Pros channel, and we'll have Ian giving that for you. And until next time, this is Rob Kientz with Gold Silver Pros.